We're going to talk about the future of development in Los Angeles in Southern California. For those of you that don't know me, I'll introduce myself, and then I'll let the panelists introduce themselves. We'll do 40 minutes or so of Q&A, and then we'll also open it up to audience questions. If you guys have a burning question along the way, feel free to raise your hand. I'll call on you, one of them will call on you, and we can take some questions interspersed throughout to kind of keep things moving and interesting. So for those of you that don't know me, my name is Zach Streit. I am founder and president of Priority Capital Advisory. Priority is a boutique debt brokerage firm based here in LA, pretty much focused on deals that are $15 million and up across asset classes and focused on the Western US. Matt, you guys should move forward, but why don't you introduce yourself?
Sure. Matt Sicati, pleasure to be here. Thanks for inviting me. I'm with Hines. We're an institutional development and investment management company founded in Texas, still family owned, with offices around the country. We invest in all property types up and down the risk spectrum, so office, residential, retail, industrial, and alternatives. And I think that's it. Excited to be here.
Great. Small firm no one's ever heard of, that's for sure. Ben, go ahead next.
I'm Ben Grossberg. I run capital markets at Eterra Development. We're a local, also family-owned developer, owner, operator of multifamily and self-storage. Most of our portfolio is here in Southern California, but we've been expanding out Sunbelting, as many others have been recently. We've got 3,000 units currently in ownership and under development of multifamily and self-storage. We have around 1 million square foot across mostly Southern California, and looking to expand both those platforms.
Great, thank you. Adrian.
Good morning, everybody. Great to be back in this room for the first time in a while. Adrian Berger, Managing Director of Acquisitions at Cypress Equity Investments. I oversee our national acquisition strategies. We are a locally based family office focused on market rate and low-income housing, multifamily development and investment. We also have a self-storage division, and we've been a very active co-GP across various asset classes around the US. Since the company's inception in 2001, we've done more than 160 projects, about 21,000 units, and about $13 billion of total capitalization across multifamily and other commercial aspects, and it's great to be here.
Great, awesome, thank you. So just as I think about the development landscape today, there's no question that it's tough, right? Things that, thank you. Things that often come up and issues, headwinds, people talk about tariffs. Maybe we're in a state of reprieve right now, but where does that go? LP equity, kind of, is that available? Because maybe it hasn't been, or it's been more muted, regulation, et cetera. So I think we're gonna focus on all of those things, but I thought to start, perhaps let's spin it positively. Let's talk about some of the things that maybe are working out there and deals that are getting done, and kind of understand how they're getting done. So I think to start, Adrian, I'll pick on you, because you were last up there, and maybe talk to us a bit about the LP equity market. Cypress knows it well, knows it deeply, has done institutional deals before. Who's out there? Who's active? What strategies are they focused on?
Well, I'll start with the positive. LA still has a lot of sunshine, so that's a really good positive. But the LP market,
generally no rain at the beginning of June.
I know, except the last 24 hours. We've historically capitalized our deals with institutional equity. We never went down the route of syndicating capital on deals or family office, which, I think it's always good to have a variety of sources, and I think that's something that we're focusing on growing more, so we have more variety. But focusing on the institutional equity space, I think the uncertainty really affects those groups. I think there's some of them have a lot of money left over from funds that they're trying to put in places, and we just closed a deal with one of those groups in Santa Monica because they had $250 million left in a fund that had to get out this year. Others are out there trying to raise capital right now. I think that they're all interested in getting back in the market, but I think that it's a hard time for them to get confident about where the market's going. I think uncertainty really sidelines institutional equity, and I think that once they start to see their competitors getting back in, I think that's when they all sort of jump back in. So what we're seeing at the moment is the biggest interest level we're having is in our low-income housing tax credit business. I think affordable housing has incredible tailwinds in California and nationally. I think that everybody is aware of what inflation has done, what coming out of COVID has done in terms of the cost of living and how difficult it is for many people out there. So that business is getting a lot of attention because historically institutions haven't been in that space because it's not a asset class that is capitalized with institutional equity. So I think that's a really amazing opportunity and something that we've been doing for about 10 years and are really investing to grow that business and seeing a lot of institutional equity come to us and say, how do we grow this with you? Another area, and I'm sure Ben will talk about it also because Latera does this, is self-storage is also historically been not a high up there on institutional radar because the check sizes are small. But we're seeing more interest in that space as well, and there's also some pretty good dynamics in Southern California. So, I mean, that's where I think I've seen it. There's been a bunch of discretionary, distress money raised, but there's not really any deals to do. But
Right.
I mean, that's been my what I've been seeing from the institutional LP side.
Yeah, that's really great. And echo what he's saying. I would say from a brokerage perspective, I don't know if I've seen more equity requests from developers than what I've seen in the last 3 weeks. Once tariffs and the reprieve hit, I probably got 10 requests in from developers saying, hey, find equity for a development deal, find me equity for a value add deal. Now, not all of them are created equal. It's got to be the right sponsor in the right market in the right location. But there was sort of an entrepreneurial fire that was stamped out, I think, by tariffs. And at least that's back. And the availability of debt capital is back from banks. So those are some precursors. You need both of those for institutional equity and other forms of equity to sort of take root. And at least we have those. But I also agree with Adrian. I haven't seen many institutional deals deployed. We launched a deal last week. It was a $30 million loan and probably $15 million of equity or so. And the equity capital provider was a high net worth, a local kind of tech-based investor that had a massive exit. It's a household name you guys would all know. It happened to be an ED1 deal. We'll loop back around and talk about that because that's probably a subset of affordable, and there seems to be interest in that space. That was one, and then we're working on another, call it $25 million loan in Culver City, and that equity is being syndicated. Because that's the other major way deals are getting done today. When there isn't a 90% capital partner that might step in and do your deal, you've got to go and you've got to cobble it together. Maybe you up the leverage to make life a little bit easier, to raise less equity if you're confident on the takeout. But it still seems to be a landscape today that where you can find it, it's dominated by let's say, kind of high net family office syndication type landscapes, at least within multifamily development. And both those deals that I mentioned were multi. Could be a bit different if you were talking about data centers or storage or for sale housing or things like that. On the multi front, Ben, I want to direct the next question to you because I think multi is often a bellwether. Obviously, we're undersupplied on housing. It's had its challenges, but Latera has been successful in entitling and capitalizing multifamily development deals, and some really prominent and really big ones. So maybe talk to us a little bit about kind of Latera's activity in the space and sort of what you see in your crystal ball for the next 6 months.
Yeah, we've been pretty successful in entitling deals. I think the number is 45 out of the last 45 deals we've been able to entitle over the multifamily and self-storage platforms.
So knock on wood somewhere because that's a pretty good.
Yeah, I'm definitely not responsible for any of that. Definitely riding that wave. But what is working? I mean, we have a big development, pretty notable up in Burbank. We've got two there. One, we're just finishing our LP there, is a institutional Canadian pension fund, and they're long-term holders. It's a closed-ended fund, and we've seen others, peers in the industry kind of trip up because their capital is a little bit more trigger happy and they want out, and they're not as long-term. So we've kind of, the build to core, access to capital that we've had in the past and still do have has been really helpful in this market where the institutions are having a tough time, either raising capital or there might be redemption queues in open-ended funds. That's definitely worked for us from a capital availability perspective. And then I guess on a deal perspective, it's very tough to make multifamily work, tariffs, interest rates. The one thing LA does have going for it, besides from the fact that the weather's awesome here. One of the reasons why I'm here.
It's because you're from Melbourne.
Yeah. He's from Sydney.
Zing.
A little bit better weather, but I hear the people are better from Melbourne anyways. But
I'm more arrogant from Melbourne.
I'm a Philadelphian. I'm going to stay out of it.
Yeah.
We're gonna start punching in a second. Don't worry.
it's part of the culture. Anyway. But yeah, look, the cost to build is so high. Between interest rates, cost of labour and cost of goods. But the deal that we have, for example, in Burbank, we're breaking ground on shortly. It's the old Fry site. We own it in a JV with the landowner who's had it for around 20 years. So we're kind of ticking all the boxes. We've got really low land basis. It's really high demand drivers in Burbank. Nothing institutional has been built there for a very long time. So we're getting really good rents, or projecting really good rents. So kind of the barriers to entry in certain SoCal markets works well for developers when you can kind of tick the other boxes. We're building all above grade, so we're not going sub-T. It really helps. It's built over 8 acres, but that's kind of a unicorn property. It's very tough to hit all those drivers. But yeah, it can work. If you tick all those boxes, it definitely can work. And the jobs to housing ratio is where you want it to be. There's like 150,000 jobs and 40,000 houses or housing units. So it does work when it's good, but it's so tough to find that in multifamily. What we've been able to make work in the past, it's a different road that we're taking now, that's for sure.
And just quick follow-up on the Fry's deal. On that deal, is there sufficient equity kind of in the land or with the landowner to sort of capitalize a deal entirely with a construction loan, or are you bringing a new equity partner into that deal, and is it the same or different than the other deal you have close by?
Yeah, definitely. We're bringing in a new LP equity partner. The amount of quotes that we got for structured finance, we got a lot of pref, a lot of mezz quotes, and we're sort of shying away from that because we don't want the deal to be binary, like, either you knock it out of the ballpark, which we're pretty sure it will happen, but we don't want to load it up that, after 2-3 years there's a really expensive prep kind of ticking away, and, we'd rather either do it with a traditional LP or just not do it.
And how tough was it for you to find that tradition? Sorry to put you on the spot here. How tough was it to find that traditional LP?
Yeah, really tough, especially when you're in out of town and you just kind of follow the roll. But yeah, really tough. But thankfully, the guys at Laterra, we've got we're vertically integrated. So the LT Building Corp, they're awesome. We have, someone from Wood Partners. He was at Wood Partners for 20 years, built all up and down the country. So really easy when you can lean on expertise like that.
Got it.
What's the profile of the?
850 units.
The capital partnership.
Oh, the capital partner is private capital.
Is that a phase project?
Yeah, we'll be building 2 phases. Around
Yeah, I think the key of not going subterranean, that's so huge, makes the deal work.
Essentially. Almost all the deals that I'm working on capitalizing, whether it's the one in Culver City or Westchester, or another deal that I'm working on in Santa Barbara, and these are all pretty large ground-up construction deals. They're all either surface park, or very limited parking, using something like ED1. The second you go subterranean, the costs just seem to get out of control. The return on cost isn't there, and it seems like the developers and the equity all feel like those deals aren't worthwhile, so you don't see too many of them proceeding. So we'll turn to Matt now. So Matt, Hines, household name, everybody knows them. Maybe predominantly as an office owner, which could be tough right now, but talk to us a little bit about what Hines is doing from a development perspective. I wonder, are they doing any office? I would tend to doubt it. Very few people are, although there's one going up in Century City. And if you aren't doing that, then kind of, where are you guys focused? Because clearly you have access to a ton of capital and, one of the longest institutional track records around.
Sure. So I'll just start by talking about our focus on office right now. I'd say from a macro perspective, office has obviously been hit really hard and has been a 4-letter word for the past few years. But if you really look at the data, the fundamentals seem to have really bottomed out. Work from home is pretty much priced in, and we've actually seen positive net absorption the past few quarters, and that's not just trophy assets. So It seems that fundamentals are improving. Capital is still cautious, but I would say FOMO is starting to settle in here. So we remain absolutely committed to the office sector. I don't think we're going to be developing an office tower anytime soon, but we're really attacking it from 3 major strategies right now. That's credit, management services, and next cycle acquisitions. So talking about each of those individually. We were talking about debt before. Hines, just recently, about a year ago, launched an office credit fund with Rialto Capital Partners. So we're issuing senior mortgages, buying loans and loan portfolios, and providing what I would call structured credit, mezzanine debt, and pref equity, all tied to Class A office properties. So we're closing deals around the country right now, and I'm happy to say the first deal that the fund closed was providing some mezzanine debt as part of a recap of a creative office portfolio right here in Culver City. So the strategy there is to take advantage of reset pricing and the need for fresh equity, fresh capital, to derive strong risk-adjusted returns. That fund's targeting high teens IRRs fund-wide. So that's one. Management services. We talked about this before, but if you just look at most of the office transactions that have happened in the past few years, it's high net worths predominantly, or non-institutional buyers, really a basis play for them. So we, Hines, have been positioning ourselves as a service provider for those groups, providing facilities, property management, asset management, leasing services for those groups. So we just recently picked up an assignment on an office tower in San Diego that was purchased by a high net worth, and we're pitching a number of those opportunities right now. Lastly, and this is where it starts to get more exciting, I'd say, next cycle acquisitions. Our funds, from a capital perspective, as you noted, we have a number of discretionary fund vehicles. They invest up and down the risk spectrum. We also have a number of third-party allocator relationships that we've done deals with historically. What we're doing right now is, for instance, we're closing a deal that is, I would call, a mixed-use acquisition that includes an office component. So that's a data center, that's a self-storage development site, and some Class B office. We're frankly not ascribing that much value to the Class B office component, but we're certainly comfortable managing that as part of a larger business plan. That's happening right now. And then, as we sort of think forward, our fund vehicles that have had no interest in office in the past few years, at least one of them has said to us, we want to make a big office acquisition at some point here in the second half of the year, which is that's their first acquisition since the pandemic. That would probably be more of a longer wall, core location, high quality asset, so core plus returns. But then, really where we're excited in terms of the Hines SoCal office is these third-party allocators that we've done a number of office deals with, development and opportunistic acquisitions historically, are now coming to us in the past few months and saying, we're ready to really start leaning in here again. So I'm hopeful we'll close a couple of those, what I would call opportunistic acquisitions, targeting north of a 20% levered IRR with third-party capital on, let's call it a restore to core type business plan. So not any typical development, but we're very active on the office side and definitely very excited.
That's really good to hear. Not many are.
Do you think the values have bottomed out in LA for the office?
It's so hard to answer that question because, as we're going to talk about as we continue on here, and as already alluded to, there's just so much uncertainty in the market just from like a macro perspective. I think LA and the West Coast in general led on the way down just because it's so tech heavy and the pullback in tech was so significant. It does seem like there's a lot of back to office, 4 days, 5 days in the office if you look at Amazon. And so it seems like tech is starting to nudge people back in, which I think is a positive sign. Fundamentals, as I said, positive net absorption for the past 2 quarters, and that's not just the trophy assets. That's not just the 6% of the market that's traditionally had 20% of the leasing. It's like Class A minus product as well. So we're very optimistic. I would say that's really where we're focused, is Class A and trophy. We're not really focused on Class B and C, unless it's an office building that needs to be something else.
Right. Now that makes a lot of sense. It's going to be a good segue because I'm going to ask you, Adrian, next about LA, but I brokered 3 office deals and closed them in the last year. 2 of them were in LA. And so I'd go out on a limb and say, yeah, values have probably bottomed. Now, if you're a half-empty commodity office building and there isn't a path forward, like that's probably tough, but those values may have bottomed too because we've all seen trades and then retrades or second generation trades of stuff in downtown LA, and we kind of know where that market is now. It's ugly and it's tough, but it's there. One bright spot, this isn't in LA, but last week I got a $26 million loan signed up on a half-empty, 400,000 square foot office building in Houston. Took 100 lenders, 99 said no, one said yes. But I think 6 months ago there wouldn't have been capital for that transaction. And I asked the lender that ultimately did it, I said like, all right, you gotta know you have all the leverage here. I mean, you know the state of the play of office market. Why did you do this deal? And by the way, that lender has an equity side and they own an office building in Atlanta and they're being foreclosed on. And their response to me was, and I brought that up too, I'm like, hey man, like is the left hand talking to the right hand here? Or like, what's gonna happen? And they're like, look, we would have worked out that deal if our lender in Atlanta let us, but they're not. But we believe cyclically that the office market has bottomed. And so we're making a big macro bet. We're not doing every deal, we're not doing every location, but this is, I mean, if the sponsor were in the room, I'd say an A- property, but it's probably a B to D plus property if we're calling it what it is. And so,
Such a broker.
Well, I make no illusions about that.
It's prime.
That's exactly as prime. As prime as Class A was built yesterday, but somebody stepped
Call
up.
them magnet properties because they attract.
Premier trophy properties, all that's good. But somebody stepped up and did it, and I really believe that 6 months ago nobody would have. And so what Matt's saying feels directionally very correct. Okay, Adrian, I want to loop it back to you, and I want to talk a little bit more about LA. You guys, Cypress have been some of the most active and largest developers in Los Angeles, and in particular in Santa Monica, on stuff that is either adjacent or very close proximity to the beach, amazing locations. How do you feel about LA over the short term? And feel free to touch on just city budget issues, quality of life. Are you a buyer? Are you a seller? Regulatory environment, etc.
Yeah, I think it's a complicated time in LA. I've only been here full time for 10 years, but have seen a lot of changes in that time. I was fortunate when I moved here from New York that I lived in Santa Monica, and that's how I got to know the city, because our principal, Michael, said to me that he would buy anything on Wilshire Boulevard at $500 a foot on the building. So I was like, oh, that's easy. I'll just go out and do a bunch of deals. And it was really challenging, and I think through that I learned the uniqueness that Santa Monica, the unique place that Santa Monica is in many different ways. I think in the short term, I definitely have some concerns. I think, what's happening with these punitive transfer taxes that have come in, the disconnect between the perception of, what developers do and what they should do, for people who are outside of our industry, I think is troubling. We're in this business, we're for-profit companies, but we also are trying to provide housing solutions to the city, which desperately needs it, and we're often treated with a lot of disdain, even though we take a lot of risk. So I think that in the short term, I've got a little bit of concerns about the budget situations, the quality of life, some of the general attitudes that these cities have. But I think long term, LA has a lot going for it. I think there's a lot of good, more diversity in the job market here. I do think that the film industry will figure itself out at some point, and maybe that's its own cycle. I think what's happened in the Palisades and out in Altadena is going to create opportunity to spur new things. But we like certain pockets of LA for certain types of investment. So for market rate multi, we think Santa Monica is fantastic. I mean, there's no higher rent submarket in the city. The demographics are phenomenal. The quality of life has dipped a bit, but it's still very strong. So I think in the medium to long term, I think LA is going to be fine. It's a very big city. People aren't going anywhere. There's a need for housing. Santa Monica has become an easier place to do business, and I think we're fortunate because we've been developing there for 15 years, so we have really strong relationships, so we understand how to get through that city. And we have a pipeline of about 2,500 units that we can develop there that we have in entitlements right now. And we believe we're going to break ground on all of that in the next couple of years. And if you think about looking at the deliveries in Santa Monica over the last 40 years, it's been anemic. It's been less than 5,000 units. So there's a real opportunity there. So that's why I think we're very focused there. Outside of Santa Monica, I think it's tough to pencil anything unless you can surface park on 8 acres, which is pretty rare. So yeah, I think that's an opportunity. And then on the self-storage side of things, I think Southern California, Greater LA has tremendous opportunity because it's it's a use that most cities don't like. It's very hard to find the zoning for that, but there's a tremendous amount of demand from people out there. So I do think there's some good grassroots opportunities. One other thing I'll touch on is we partnered with a group recently that has a very unique strategy, taking advantage of the updated ADU law, and they're focusing on buying old stock, rent-controlled infill buildings that have surface parking or detached garages, and using ADU as the value add strategy. So not trying to go in there and buy tenants out or force tenants out or whatever. It's really more adding density to create that value add return. And we've seen a lot of interest from capital. We've already closed 2 deals. We've got an institutional group that's recapping part of their portfolio and making a forward commitment. So we think that's a great place to focus also.
It's a great group. I know who you're talking about. But I want to go back to one thing you said, because it struck me, and hopefully it struck other people. I thought I heard you said, it's still early, but that Santa Monica has become an easier place to do business. I don't think I've heard anybody say that about any city or submarket in Los Angeles ever. So I'm going to put you on the spot a bit. Can you comment a little bit about what's changed or why that is?
Yeah, I think a couple of things changed. I think that historically Santa Monica had a very stringent discretionary entitlement process that you had to go through a lengthy, development agreement process. I'm not going to speak for Hines, but there are stories from way back when the pencil factory, all those things. I mean, the development that we did on Lincoln and Colorado took 5 years to entitle. So bash your head against the wall, right? But that sort of has been changing, and I think with the state mandating more housing and putting like the carrot and the stick with these cities around, if you don't perform the housing, you're not going to get certain funds, forced a lot of these cities to change their tune a bit. So it is still not easy to go and get an entitlement in Santa Monica. You have to understand how to play the game and use the system, but it's a lot easier to get to that entitlement than it used to be. I think for us, we're fortunate that we've round-tripped, built and stabilized 7 projects in Santa Monica since 2010. And so we've got a really excellent reputation in the city. And when in COVID we went out and bought land, I went out and bought 17 land sites in a 3-year period in COVID that turned into this pipeline of opportunities. Like we now have we now know the staff that we're dealing with really, really well, right? So I think for us it's become easier, but I think for other developers it's become easier. The timelines are longer, but in terms of getting through entitlements, that part is what I meant by getting a bit easier.
Wow. All right, that's really great to hear. All right, Ben, we'll turn it back to you. Adrian mentioned storage and he's somewhat active in it, but I figure you're a great guy to talk about it. So, Latera historically is mostly known as a multifamily developer and investor, and of late, you've grown a storage platform. So maybe talk to us a little bit about what you guys have grown, and then more specifically, what is the opportunity that you see in front of you guys in terms of self-storage in Southern California over the next 6 to 12 months?
Self-storage is the least sexy asset class when you're looking at like an investment memorandum. So that's kind of how I started dipping my toe into it personally. But Latera, we got initially
I feel like Adrian has to jump in on that and say, yeah, it must be a Melbourne thing, but sorry.
I've given him enough grief.
Okay.
We shy away from being, we like to just get deals done the least sexy way, but we like the returns and not.
He likes his lie on the beach and
So look, we got a great capital partner on the self-storage side of things. It's actually an Australian fund. I can't take credit for that, but I will when people hear my accent. But the institutions have been seeing self-storage as a less of a like outlier asset class, and now it's more of an alternative, much like data centers. It was tougher to get them done traditionally because it's a low equity check per deal, unless you're building like a monster development. But the reason why we like SoCal for it is just the density, right? It's your square foot per capita. That's the name of the game in self-storage, and there's a lot of housing that essentially isn't big enough, a lot of apartments. People need storage to, whether they're moving in or out. A gateway city is a perfect place to put self-storage. And there's also, people don't talk about the tenants that are more like businesses, like the HVAC, the gardeners, the pool guys. We're seeing a lot of our tenant base be, more those small business owners, and they might have like a few self-storage locations, like they're renting a few self-storage locations up and down the coast because they'll have different projects at different times that they're carrying out. So we see it as, from the development side of things, we can actually build to a 7 yield on cost, which has been like the magical number for a lot of institutional investors. A big reason for that is that the land is a huge portion of the total development cost versus, let's say, multifamily, where fixtures, fittings, and all the finishes, they get pretty pricey. But self-storage is pretty simple. You just build a box, concrete box, and there's not much, plumbing and electrical. So it's, the land cost, if you can kind of keep that down, do the entitlement right, it still works from a development perspective. And the other side, we're also looking at buying existing self-storage, which, we're a little bit of the ugly duck from an institutional standpoint as well, because smaller equity checks, there's not much that you can do. It's more, replacing the management, buying from a mum and pop owner that hasn't necessarily run it as an institutional business. It's more of like a slush fund, running a lot of expenses through there. So you kind of have to get in the weeds on a T12 and figure out, as an operating business, does this really work? So you're buying the business and the property. So, we're seeing some good opportunity there to kind of buy the smaller, I say small from an equity check, there's still, 800 plus self-storage units, rolling them up to a more kind of institutional exit, whether you can put a real cap rate on it. And, from buying like core self-storage deals, it's a very, very competitive landscape. We're getting outpriced all the time. And a lot of the time they're like 4 caps on the fully operating ones. But the more value add, mum and pop owned, like I mentioned, that's when we can apply our expertise in house. We've got a really good self-storage team that we brought across from Public Storage. They ran sort of the west coast for Public Storage. So those have been the two ways we're making self-storage work.
Got it. Let me ask 2 quick follow-ups. One, you mentioned you can build to a 7. So what can you exit at? And then the second question is, in your view, for storage over the next 12 months, is there equity capital available for it?
I'll answer the second question first. Yes, I wish there was as much equity capital that we're getting for self-storage for multifamily, because it's become a darling asset class. There's not many operators out there doing it, and there's much less competition for capital, and a lot of more institutional investors are under-allocated in the space, and they want to get educated on it, and it's a much different conversation because you're kind of walking a lot of the capital sources through the actual business plan versus, hey, do our deal. And then the first question
was you said you could build storage to a 7. And
Yeah.
I'm wondering, what sort of pro forma spread is that to an exit cap?
So we haven't exited yet, but we're pro formaing like a 5.5 exit cap. But we're seeing, again, we're getting beat out we're looking at core deals to buy, and those in SoCal, like in Orange County and some in LA, those have a 4 handle on them, like
Wow.
4.75. Yeah.
Wow.
Yeah. So they're, to the extent that there is.
Those must be cash buys, right?
Yeah, core funds, cash buys.
Got it.
I'll chime in and say that
Yeah.
this is definitely a new element of focus for us. To your point, as soon as you call something an alternative, you're going to get institutional capital that starts taking it much more seriously. So Our Core Plus fund has acquired 2 self-storage assets on the West Coast in the past year. Those are more of a value add business plan. I'm going to get past my level of expertise very quickly on this, but I think there's what ECRIs are the rent increases that are typically phased in over a longer period of time, 3 or 4 years.
We call it ECRI, so we don't say that we're upping the rents.
Yeah,
It's more technical.
Yeah. So they bought those, and they're actually the investor on that deal that I referred to before that incorporates a self-storage development aspect to it. So they're absolutely thinking about it the way that you're suggesting, which is a portfolio aggregation play.
I mean, we're seeing similar things. What's interesting about stabilized storage, like anything, you know, there are developers that take the risk, right? There's a lot of risk in development, and then there's buyers of the finished product, and there's a lot of those buyers. And I think what's happening is there's more and more buyers of institutional quality storage assets than there ever have been before. I was listening to a podcast or something that the allocation of institutional investment in this alternative is quite actually relatively small, but there's not that many big institutional deals out there. 70% of the national self-storage ownership is still non-institutional. So it's really has been historically a very mom and pop, you know, operating, more of an operating business, right?
Sounds like build to rent.
Yeah, so exactly. So it's kind of now like it's getting the attention of big institutions, which is a good and a bad thing, because you know then it becomes more commodity. Like we're in the multifamily business, and the margins have become so thin because everybody has the information, everybody has CoStar, and everybody sees deals, and everybody wants to buy it. So that's part of the thesis of moving into some alternative strategies like storage or low-income housing. The other thing I would say is that California can't help itself but to try and now legislate around this industry, and there's been a ton of legislation that's been proposed to initiate rent control into self-storage, which you know is just a very interesting approach to killing business, which has a very clear playbook from the multifamily side. So you know there's a lot of very active organizations pushing back against that, and there has been some very aggressive ECRIing tactics that I think have probably been not fair to consumers, and I think that's why it sort of got to this place. But you know, it might be a short window here for storage, you know, in terms of being able to do it without being regulated.
No, those are like aggressive tactics. There's a way. We're hoping that they've found a way to quash those, but they almost passed a rent control legislation a couple of weeks ago on a rent cap, which would have just almost killed the industry and just maybe marginally dealt with the real problem. But yeah, hopefully there's enough pushback that you know it won't be another multifamily story here in SoCal.
But the problem is that California, like the legislators don't stop when they don't win the first round of new legislation. They come back and come back and come back. I mean, so that's sort of the more, I guess, long-term concern with the industry in California. I was talking to an operator that like basically was leasing up a new asset, and the fires started, and it was the rent sort of cap moratorium or rent increase moratorium, and then this legislation almost passed, and they would have basically been stuck at their lease-up rents, which in storage is 2 rounds of lease-up, and that they basically it would have basically made their property go down 2/3 in value. So it has real impact on investors.
Yeah. I was going to ask Matt a question on tariffs and what they're doing in the industrial space, but before I do that, since we're running short on time, questions? Anybody have one? Dave, go ahead.
Adrian, so what's your plans with 26th and Wilshire and the Gap building?
Yeah, so 26th and
You wanna
Wilshire.
just repeat the question?
Oh yeah, what's our plan? We own 2 of the assets we own in Santa Monica. One's on 26th and Wilshire where the Starbucks and the pickleball courts are, with the parking in the back. And then the Gap building on 20th and Wilshire. So those are fully entitled. We have a capital partner on those deals, and we've got a lot of deliveries that we're sort of trying to phase. So we're figuring out which ones are going to go next. I think our project on Pico Boulevard, right near Main Street, is probably going to be the first one to go. And then we're going to focus on the Wilshire projects. We also acquired that little 3 or 4 tenant retail next to the Gap. So that became an assemblage, which kind of slowed us down a little bit because we had to go and re-entitle. But we're going to be building those.
Are the pickleball courts right behind the building?
So I don't know if you remember, there used to be the tennis center there at 26th and Wilshire had like I think it was one court, and then when pickleball became, one of the fastest growing sports in the country, they basically converted to 4 courts and just turned it into pickleball.
I have a follow-up for the Heinz guy. if you don't
Yeah.
mind. So this isn't SoCal,
Going to
but
be known as the Heinz guy.
I can't start. Is it Matt?
Matt, yeah.
Matt. Okay. Hey, Matt. The guy without an accent. How about that? Or the only guy with an accent, if you're asking those two. Big fan of the mixed-use projects you guys have done. The Avalon in Alpharetta, Fenton in Raleigh. It's one of the few. They're one of the few true mixed-use developments that I think are tremendously successful. Are you guys planning to continue that prototype and anything in Southern California that we can look forward to?
We should add West Edge to that list.
West
Great
Edge.
Yeah,
job.
so it's a huge element of focus for us.
Okay.
Challenged multifamily feasibility notwithstanding, we are absolutely committed to what we call mixed-use placemaking as a strategy. So we have our West Edge project, which you may be familiar with. It's at Olympic in Bundy. It's actually where Heinz has recently moved our offices. So Riot Games took most of the office space. It's also 600 podium apartments. There's a Gelson's that's open, and we're populating all the retail right now. Very successful project, like I said. We just refi out the construction loan on that one. We're in various stages of entitlement and pre-development on a number of different large-scale, multi-phase, mixed-use developments in Southern California right now. One that I'm spending a lot of time on is our Village Santa Ana project, which is down right next to South Coast Plaza, the shopping center in Santa Ana in Orange County. So that's going to be about 1,600 apartments, 80,000 square feet of retail, and if you can believe it, we're entitling 300,000 square feet of office, all clustered around Central Village Square. And then Riverwalk is another project that we've entitled down in San Diego for over 4,000 apartments. I'll be really quickly. On those are all legacy landowners that own the land on those parcels, and we've actually partnered with them and are going out and getting entitlements with them, and then we, Heinz, bring the vertical capital for those developments, but allow the legacy landowner to stay in the deal as an investor. It's one way that we've been able to unlock incredible opportunities while also finding a structure that mitigates risk from an entitlement perspective. The landowner contributes the land at entitlement, which just acknowledges the fact, what these guys are both talking about, that entitlements take a long time. There's just a lot of risk and uncertainty, especially for an urban scale project like this. But it's the future.
That's what you did on West Edge, right? That's exactly
Yeah, that one took a long time. And Adrian was referring to some challenges that we had in Santa Monica, which he's right. I will say we spent 8 years trying to entitle a project in Santa Monica that ultimately we did not get approvals on. It's a whole other story. But the landowner on what now is West Edge was watching that process. And I had nothing to do with this, so I don't take any credit for this. But they saw the way that Heinz performed, even when Santa Monica ultimately said, no, we don't want this project. And that ultimately was the impetus for us getting that deal to work with that landowner on our West Edge project. So a little silver lining for what was.
Land JVs are the best strategy, I think. We've done a few as well.
So I actually
Deepa.
have a question. We haven't spoken much about affordable housing. So thoughts on that? Because we do need housing, so any?
Yeah, I mean, I'll address a couple of things there. So, like I said, we're very focused on the low income housing tax credit business. So that business relies upon you winning a bond award from the state, which is a very complicated and competitive process. And again, lots of risk. You've got to basically be ready to, once you get your bond award, you have to be ready to break ground in 6 months, right? So that means you've got to have your plans to a certain place where you can then get your construction drawings done, your permitting done 6 months after award, which, if we've talked about, is very hard in California. And it might take you 2, 3, 4 rounds to win your bond award, which that's years. So it's become more competitive because market rate developers are trying to get into the space now because market rate development doesn't work. But there is a large bond cap in California, and it gets fulfilled every single year. So there is a lot of deals getting done. They're just not happening in infill places because you still have to make the deals work from a construction type standpoint. So podium with subterranean parking doesn't work. It's mainly going to be suburban garden style. because those bonds are your equity in the deal, and if the deal doesn't work, you're left with a gap, and then you got to go out and try to raise more traditional institutional or more traditional equity to fill that gap. So we see a tremendous opportunity in California. We have 6 land sites under contract right now, up and down the state, from NorCal, Ventura County, Inland Empire, Orange County, and we're trying to get something done in San Diego with one of the transit authorities. So that's really tremendous. And I think more locally with traditional sort of affordable housing is the infill stuff that I talked about on the ADU side, because those are sort of smaller deals, but there's a really great way to unlock. So for example, we're buying a 20-unit building and we're able to add, call it, 12 ADUs, that you're almost doubling the density of that site.
Can you talk quickly about ED1? Because I think it needs to be part of the conversation. I know you have reservations about it. Maybe talk about those too, Adrian, but at least for me, I closed an ED1 construction loan in December, and we launched another one now, and we're gonna launch a third one next month. So it seems popular amongst developers, and they somehow seem to be able to source the equity for it, which is critical.
Well, I mean, if they can do that, that's great, because I think we've looked at it, and I think it's the challenge that we saw is that you're getting a tax abatement, which is great, but you still have to go and raise traditional sources of capital, which has been the challenge, right, in this environment. I think when we build projects and entitle projects, and we're managing a lot of assets in Santa Monica, we've seen an increase in parking demand. So we've actually had to increase the amount of parking we're providing, and ED1 is all about parking reduction. And so what we've looked at, these deals, we've been approached by developers to co-GP and stuff. I just find it hard to believe that you're going to get the rents you're going to get without any parking in a part of LA where there's no street parking. So I know that we all wish that it was different, but I think that that's really where the rubber meets the road for us for it not working.
I hope those groups are successful. There's a lot of examples of
I hope
projects
so,
where people are trying to get really aggressive at cutting parking as much as possible. We probably wouldn't be comfortable with that for the reasons that you alluded to, but I would love for some of those examples to be set of renters, maybe younger renters that are just way more used to using Uber and things like that, not needing cars because parking is so exorbitantly expensive and you don't make much of a return on it. So that to me is one of the biggest reasons why multifamily is really challenged from a feasibility standpoint, acknowledging also interest rates and cap rates and all
Well, I
that
think
stuff.
they're doing that more next to the train stations, because I know a few projects that are without the parking, but they're near transit, so.
Yeah, I agree. I want to see it work because it just creates more housing and creates a new business plan, right? And that's going to unlock a lot more opportunity because you can now build on zoned parcels you couldn't build on before, and that just creates more density. We need to be going vertical, right? Like LA is a horizontal city, New York's a vertical city, San Francisco's a combination, but it's a vertical city. We need more density, right? There's not enough housing, right? And the only way you do that is by going up. So I hope they're successful in doing that.
I was a developer in New York before moving to Los Angeles and joining Hines, and we never talked about parking. You hit whatever the minimum was, you never talked about it at all.
Yeah.
And now it's the tail that wags the dog in this.
For
town.
sure. Yeah.
I'll go a little bit further out from that, and I still look at things almost like as an outsider. In Melbourne and Sydney, like the two biggest metros in Australia, public transport is a huge reason why CBDs and cities can build vertically. It's just a huge issue here in LA, and you're talking about people using public transport. Like the city has to do something about the public transport system. Like the existing system isn't great. Like I wouldn't even think about taking my little kids on it. I wouldn't think about taking it, and it's just the infrastructure that's been built out is a tiny portion of what actually needs to be built. So
I think Chris has a question.
All right, last one because we're already 10 minutes over, but go ahead.
So with that being said, I'd like each of you to speak to kind of your 5 to 7 year thesis on LA, knowing that we've got the World Cup, the Super Bowl, and the Olympics. There's a lot of money invested in infrastructure, LAX, transportation. So where do you see that having an impact longer term on LA, and where do you see opportunity, and what should the city start doing now from a public safety perspective, and how do we take that through the next?
I'm not going to address public safety because I'm not. That's a big whole other discussion. Airbnb. That's where that's what's going to benefit the most, right? People renting out their houses. But I don't know. I like I alluded to earlier. I think we're in a very weird moment. I think we're going to know more the next mayoral election, the next election up in Sacramento. Usually these big sporting events are great, but they create a lot of income in a short period of time, but at a cost to those cities, and the infrastructure that gets built sometimes is not built for a future use, and it's just wasted money. So, but I think it's exciting that LA is going to host all this stuff. I just hope that the city, is a bit more cleaned up by then.
Yeah, no, I agree. Everyone kind of looks to Rio and where the World Cups and Olympics have been in the past, and it's almost like a tale of two cities where there's like all this hype leading up to it, and they're building all the infrastructure and housing for it, and then after it's almost like a shell. But LA kind of does have that dynamic where it's severely underhoused. So maybe it'll be a silver lining that there won't be these shells of apartment buildings and infrastructure left, because there's this just pent up demand that's there that hopefully we'll be filling.
I think I'm thinking about this in terms of just the urban form of Los Angeles and the infrastructure that we're stuck with, for better or for worse. This is a city that was built for the car. It's always going to be a city that's built for the car. We're spread out geographically. If you just look at the amount of land area that Los Angeles takes up in comparison to New York, it's a very stark picture. We can't change that. So as I'm thinking about the next 5, 7, 10 years, I'm thinking about, frankly, technology and changes that are happening right now. I mean, I'm curious, by a show of hands, who's ridden in a Waymo? Okay, how about who would consider driving in a Waymo, or not driving, being in a Waymo in the next 12 months? Yeah, it's a much different picture, right? So I think that's going to fundamentally alter the use of urban space in Los Angeles in the coming years. And so I'm just going to go back to what I said before about a huge element of focus for us is on these large-scale mixed-use developments, because I think people crave that sort of pedestrian orientation, connectivity, mixed-use, eyes on the streets activity. It's always going to be little nodes, but then we're hopefully going to be able to connect them better with technology, because I mean, listen, I want us to do all the light rail and bus rapid transit and stuff like that we can for the Olympics, but that's not a silver bullet.
All right. Guys, I'm sorry, I know there are more questions, but I'm told we have to cut it off now.